You have a very principled modern value approach, something that you've taken from the greats such as Warren and Charlie Munger and Benjamin Graham, big names that we've big shoes that we're trying to fill in this industry. Now, I want you to tell us a little bit about how you came to decide on that specific approach and what principles you reference day to day that involve our trades and whatnot.
I think the idea is to sort of stand on the shoulder of giants. And first of all, thank you for being here, Ryan, and to be along the journey. I think our path crossed, and in life, a lot of things are spontaneous by nature, and a lot of things are we don't control all of the destiny. There are things that are fates, and I met your dad, and he made a great referral, and our path crossed, and you being a great value add to Pure Value Capital, and I hope to continue to. It's been a pleasure to see your journey, to see the growth as well, and I hope this is not just going to be a 2026 conversation. I hope you're going to be here 10 years from now.
Sure.
At some point, maybe you are the face of the firm. That's the reason why. So I'll start off by saying, a lot of financial firms who are named after people's names: J.P. Morgan, Morgan Stanley, Goldman Sachs. Those investment banks, but there are also investing institutions who's named after their own names, right? So, but the reason why I want to name Pure Value as this bigger platform, it's the idea that hopefully it lives on. It's the founder is involved, but also it will pass on sort of when the founder moves as well. So. It's part of the talent building process that we have at Pure Value, and you being on board, and that commitment has been really strong, and I really appreciate that. So with the thought of combining philosophies and how do we stand on shoulder giants, I would say I'll give you some direct names as how I think about this, just like how we typically run our investment meetings. We just dive right into it as ideas. So I think the approach, I would mention Peter Lynch first. So for those who don't know, Peter Lynch ran the Magellan Fund at Fidelity for 13 years, 1-3, had a 30% annualized return record for 13 years, and then he retired. His father passed away at 45, and he turned 45. He thought he doesn't have time to spend with his friends and family, his wife anymore, and then he just retired at a time, and it was a lot of work. And then he went on to writing books. He wrote Learn to Earn. He wrote Beat the Street, One Up on Wall Street. He had some very cool, famous interviews. People can find that on YouTube. There's one in 99, there's one in 97, things like that. They're very interesting. We might add a few clips later here and there. But the thing is, he talked about knowing what you own and the simplicity of understanding, like, let's say if you work in pharmaceutical sales, it might be better for you to invest in biotech than one to invest in Walmart. But if you were a regular consumer going down the street, he was in Boston at the time, so Dunkin' Donuts was a huge franchise. He saw their growth. He made, I believe, 4x his money in Dunkin' Donuts, things like that. So he believed in understanding what you own and sort of having that mindset and approach to things. So that's very, very important. I think the Buffett and Charlie Munger didn't come into sort of their teaching gave me an understanding of how, because Berkshire is a large conglomerate, of how businesses are actually being built and how they should be understood in a way. So I think their approach is very first principle. They don't look at stocks as stock tickers. That's the most important thing I've learned from them, is that they look at stocks as a right. If you own 2% of Apple, then you have 2% to the underlying economic rights to Apple Inc. All the iPhones they sell, iPad, Macs, and all those things. Then service revenues percentage go to the shareholders. So they don't look at the trading, the ticker, the prices every day, but instead they look at how is the business performing. That is a fundamental changing approach to, I think, for one, how to invest. Then you're really investing, you're not speculating anymore. Instead of betting on, speculating is like something betting on the horses, betting on if a cryptocurrency is going to go up tomorrow at certain prices, or if it could bring great profits, but the idea is about what the price change is and then what somebody else is willing to pay for it, versus what is the underlying asset supposed to produce. And Buffett loves to give these two examples of farms and apartments. So he's saying, if you own farmland, you care about the crops and the profits, and you're able to sell, and the underlying what the farmland is going to produce for you, the cash flow and the business itself. Now, how much somebody else is willing to pay for the farmland, or somebody bids up the price to say you want to buy that, with different. You can still choose to sell it, but it's a different game. Apartment, the same thing. You want to look at the rental cash flows and how much rent you can charge over the time, not just how much people are willing to bid up your apartments and things like that. So again, it's a different game, but investing intrinsically is something that Dave taught me that I think that's the first principle approach of pure value capital.